Well, hello everyone, my name is Ric Spooner. Welcome to this CMC Markets Education webinar covering technical trade setups. What we do in these webinars is to look at some topical current charts as they stand right now and apply some of the theory and technical analysis, theory and setups that we cover in our various webinars to current situations. And as usual, and with the same sort of philosophy we apply to our blog, we try as much as possible to also discuss actual trading strategy, and from that point of view in these webinars we will also come back to past setups that we've discussed to see how the strategy plays out, and to look at discuss techniques for doing things like making your stop loss dynamic, moving your stop loss, and perhaps even in some cases altering your profit objectives. Before I get underway and have a look at this week's charts though, I just need to pause to provide you with an opportunity to read the information in our disclaimer. Well, the first chart that I thought was interesting to look at this week is the gold chart. And what I've done here is to begin with a long-term perspective, looking at the weekly chart. And the idea here is that a very common technique that a lot of traders find really improves their profitability over time is to use a technique of using longer term charts to firstly give you a good idea of the overall roadmap of where a market is, and that often helps you determine the right way to be trading a market, and also to use the longer term chart as a way of helping to select your trades and to select those which have the better opportunity and the better risk reward profile. So the general idea is that traders will use a particular chart time frame, say a daily, an hourly, a 5-minute, or whatever they're going to be using as their decision-making chart. This is their chart that they look at most of the time, which they use to identify their actual setups, which they use to identify exactly where they're going to buy, where they're going to place their stop losses, and where they are going to place their profit objectives. But before they enter, what they do is to use this longer term chart to help identify, as I say, the better potential setups. And the general idea here is that they're looking to the longer term chart to do one of two things. Firstly, to give them an idea of the overall bigger picture trend, and or to give themselves an idea of the bigger picture momentum. And two common techniques are then only to take those trades in your decision-making chart which are either confirmed by the trend of the longer-term chart or by the momentum of the longer-term chart. So looking at the gold chart, in that context, we see this, a huge uptrend, and the fact that now for several months we've been going broadly sideways, and in doing so have formed ourselves into what looks like a wedge, or perhaps a descending triangle pattern. Clearly a downward sloping resistance across these two peaks here. A little bit of white paper here, which is sometimes short of ideal, but pretty obviously price has been batting up and down between these support and resistance lines. Now this line here is gently downward sloping, so probably best in a strict sense called a wedge, but close to horizontal, so you could call it a descending triangle as well, and really they're both the same thing for all intents and purposes. But the other thing I thought I just wanted to draw out with this chart is that those traders who use a momentum approach to dual time frame trading will use the a momentum oscillator on the longer term chart. And here I've got the stochastic oscillator, fast stochastic, with a fairly standard setting of 14 periods for percentage K and 3 periods for the moving average, which is the percentage D figure. And the idea here with this sort of analysis is to look to try and avoid taking trades that are in the opposite direction to the momentum on the higher time frame chart. And what that means is that a buyer or you only select buy setups where the momentum in the stochastic on the weekly, for example, is heading up. That is with the percentage D above the percentage K above the percentage D, or alternatively when it's down in the oversold zone down below 20. And to reject trades where the stochastic oscillator in the longer term is actually trending down or is up in the overbought zone. Now, of course, this won't always be right. There'll be plenty of times when this methodology keeps you out of trades that go on to be successful. But the idea is that with a lot of setups, what you're looking for is that even though it will do that sometimes, there will be more times when it keeps you out of potential losing trades, and the losses you avoid will be greater than the profits you miss out on, and the net result will be an overall improvement to your profitability over time. And as you say, the idea here is that you're looking to trade in the direction of that longer term momentum, because that often gives you the best risk reward setups where the market has larger moves in relation to the risk you're taking, and avoid situations where you're getting into the market against that momentum, or where the market's already stretched and where the risk reward is potentially not as good, where markets are more likely to make small false breaks and then go back to revert to the overall longer term momentum. Now, which chart you use as your longer term reference chart will depend on what your decision-making chart is. So typically you would use a weekly chart if you're a trader of daily setups, a daily chart if you're a swing trader using hourly setups, an hourly chart if you're as your reference chart if you're a short-term day trader, perhaps using 5-minute setups. So here we see with the gold market the situation where we've got this triangle and where the momentum is down in the oversold zone, and that's happened because this is such a big triangle pattern that has taken so long to unfold, creating a bias under this dual time frame approach to taking only long setups in association with this setup. And the classic triangle setup, of course, is to buy on a break above the resistance, looking then for a resumption of the uptrend or a continuation of the uptrend that led into the triangle. And to reject trades in this case involving a break below the support, looking for a correction because the market's starting from down in the oversold zone. We go look and have a look in the daily chart now. Given that sort of overall background, interesting to see that the last swing off the resistance is potentially in the form at this stage of a 5 swing down, which often happens, and that we are in a minor triangle structure now at the moment on the daily chart, and it's very typical for these sorts of patterns, triangles, to form in this fourth corrective move in a 5 swing structure. And that suggests the possibility that if we were to break out the bottom of this triangle, we might have another further leg down in this trend. Somebody trading on a daily chart, however, may be reluctant to take the continuation trade as a bottom dropping out of the bottom of the triangle, preferring to wait perhaps for a trade looking for a test of this bigger wedge support here. And what this is all leading you to is that the roadmap of the market is potentially suggesting that you could look at the possibility of an early entry into the big gold triangle on the weekly chart, and that rather than waiting for a break up through the top, if we were to break out of this small triangle on the daily now and move down and test the zone of the support of this wedge, then there may well be a setup there to get an early entry close to a stop loss and considerably earlier than waiting for price to break through the top of the triangle. So that's how the dual time frame can sort of feed into not only helping you select better trades, but also on some occasions to give you a clue about early entry. Finally, also, if we were to apply the Fibonacci type of techniques that we often apply in with these structured trades, either the 5 swing trade or the ABC trade, what we're doing here on this chart is to use some Fibonacci projections to project a level that might be the end of this little 5th swing down, this final potential leg down in the big swing that started off the top of the overall triangle resistance. And to do that, I've used a couple of standard measures. One is to project that the move down from what I should have here labelled as 4, where my mouse is, down to the final trough might be 38.2% of the distance from 0 down to 3. That's this Fibonacci level here. And it's also projected that the move down from 4 might be 127% of the 3 to 4 correction. And there we see a cluster that I've labelled here. And what this strategy does is to say if price does fall to that and then bounce up from it, then or reject that level, then that's giving you a clue to an early entry to the end of this whole 5 swing structure and a possible, as a minimum, correction of that move or larger move upwards out of the triangle. And the valuable thing about this sort of analysis is that it often gives you a clue about where the market will finish, which is actually a little bit different to the support line that most other traders are looking at. So you can see in this case this one is actually a little bit below, and that would give you a reason to be buying on the standard little false break that you might see through the bottom of that before price then flicks up. So that cluster is just under $1,500, around the sort of $14.98, $15.10 sort of a zone. The other thing that I haven't done here, just to cut down the clutter, is to look at the measuring rule, which projects that the move from the breakout of the smaller triangle here, this triangle, might be able to be measured by reference to the height of the triangle. So you take the height of the triangle at its base from 4 down to 3 and then project that from the break point down at 3, and that gets you down to a level down here at around about 1460 something, I think 1465 or thereabouts, and that would be another potential candidate for stopping this market on what looks like it's going to be a break out below the triangle, but which could be just a false break. And so again, you might want to get out Fibonacci rules if this first cluster doesn't stop the market. And by the way, these are not predictions that the market will stop there. The idea here is that if the price falls to that and then rejects it, that's your buy setup. So the other candidate would be using the triangle height on the small daily triangle at around about 1464 or 5, I think, from memory. Now, another similar market, not surprisingly, a lot of the risk markets are often in a similar sort of a position, is the UK 100 index. And here we see that the move down from the major peak has so far also potentially taken 4 swings and has all the early signs of what might be a good typical sort of a 5 swing move down. Now, to comply with this structure, this is a basic part of the Elliott wave analysis. Not only do you need to see these 4 or 5 swings, but the rules are that the swing from 1 up to 2 must not move past the beginning of the whole move down, and also that the corrective swing from 3 to 4 must not overlap through or move back up past the trough at 1. So far so good with all that. The other rule is that the swing from 2 to 3 must not be the shortest of the swings in the direction of the whole 5 swing advance, and this 2 to 3 swing is, I think, so far longer than the 0 to 1 one, but could easily also be significantly longer than the 4 to 5 one. Now, if we and then this is on the daily chart here, so I'm looking at things from a swing trader's perspective. I looked at and here we see that the stochastic here is actually trending up at the moment, so it would keep you out of a trade from a swing trade, a short trade on the hourly chart. But that can quickly change, and if price was to move a bit lower on the hourly chart, then that stochastic could quite easily just typically roll over again for a little bit of a move and a final move back down into the oversold zone, which is of course the typical sort of behavior when when price is trending strongly, that you will often see, you know, the market get overbought or oversold, in this case where I've got the mouse now broadly overbought and stay that way for a considerable time, but sometimes just chopping up and down through the overbought or oversold line. So when we get in and have a look at our hourly chart, we see another triangle formation typical of what can often happen as part of this fourth swing that I've already discussed. At the moment we've bounced again off the bottom of support there. Now one of the possibilities is that we could fall away from this level now, and what would be a classic partial pullback into the body of the triangle, and a good sign when that happens that the break that follows is going to be an effective one. So the idea here would be to sell on a break, for a swing trader to sell on a break through the support zone, provided that the stochastics on the daily chart were by that time trending down at the time you were looking at entering. The other possibility would be to sell on a test of the resistance up here, but if you're looking to be a dual time frame trader, the chances are that if that was to occur, that stochastic would continue to head up and may not, may prevent you entering a setup there, and possibly be looking to keep you out of a potential break through the other way and through the top of the resistance level. This chart is one that we looked at in our chart review webinar a few weeks ago, and which has not yet set up, but which is still basically in play. Now this is the index of the China A shares, A50 market, the major A shares, which is primarily the market traded in Shenzhen and Shanghai, which is the domestic Chinese stock market. And significant downtrend leading into this situation where we've now flattened right out, and what looked as though it might be a conventional head and shoulder to begin with, two shoulders that are around about the same level, head at the lower level, and then a break out through the neckline or the accumulation pattern for a classic buy signal, looking for a significant move upwards. But as you can see, what happened was what often happens, and the neckline held, and that's why the neckline, the classic way of trading these is not to trade until you get a break through the neckline. It's not until that happens that the higher probability characteristics of a head and shoulder as a reversal pattern come into play. And so what we've done now is reject the neckline and move down again. But interestingly, right at the moment, we now have a possibility of creating a complex head and shoulder pattern, which it works just as well as an ordinary head and shoulder pattern. And the way these are identified is that you get multiple shoulders or multiple heads. So in the multiple shoulder case, like this one, what we might have is two left shoulders, one here, I move down another one here. Then we make the head, and now we've made this shoulder at about the same level as the one out to the left, and it may be that if we were to rally up from here, we would make this second shoulder at the same level as the first one over here. So the whole thing looks pretty symmetric, which is what you want it to do. It doesn't have to be exact, but broadly speaking, the best of these patterns are when the shoulders are at around about the same level, and the outer shoulders, if you like, the complex parts, are also at around about the same level. So a move from here, making that second shoulder, and a break up above through the neckline would still be a head and shoulder pattern. The other variant of this complex pattern is where you get multiple heads. So you only have two shoulders, but you might have a couple of heads, which is something more like a sort of a double bottom type pattern in the middle of it. But broadly speaking, of course, all this is telling us a pattern of sideways and possible basing movement while the market is generally indecisive. And it's often, the whole key to these patterns is that loss of momentum and indecision very often precedes a reversal of trend. So the market is sort of fallen to a levels that it rightly or wrongly thinks is probably about the right kind of pricing to price in the bad news that it's currently got. And if from here and where that basing's formed, that if it gets some good news, often that after this you can get that particularly powerful move up, because the market's generally fallen to the level that's regarded as low enough already. So if we get a break on this, I'll come back to the blog, and as with all these setups we're looking at today, and look at potential places to put stops and profit objectives if any of them do get triggered. Next, moving on to a currency chart here. Now, this is the Australian dollar versus the Canadian, and is possibly somewhat loosely associated with the China market, in the sense that both Australia and the Australian and Canadian markets, of course, are commodity currencies, but both are significantly influenced by what happens with China. But it's probably fair to say that the influence of China on the Australian market is greater of the two. China, the Canadian market, of course, is also very heavily indeed influenced by what happens in the US as one of its major export nations. So generally speaking, if we happen to get some good news in China, which pushed us up through the neckline on the index there, then it wouldn't be difficult to imagine potentially a push up through the neckline on this setup as well. So here we've got what might in its very early stages be a head and shoulder, but firstly a good strong downtrend leading into it, which is always a prerequisite for the better quality bullish reversal patterns. We've got what might be a left shoulder, the head at the lower level, and if we do form a trough here, and we may or may not, but if at this stage we do form a trough at around about the day before, Wednesday's low, or Thursday's low, so I'm getting a bit confused, Thursday's low there, that then you can see that would have a fairly symmetrical look with this shoulder being at about the same level as the other one. And right at the moment, as things stand, we've got a possible harami pattern here with the green candle that I've got being inside the body of that first red one, and then so far this next red candle also being inside the body of this green one here. So there's a couple of inside days of sort of classic pausing sort of behavior, which if they're occurring at significant levels can potentially give you a warning that we're going to correct there and move up through the neckline. My last chart then is an hourly chart of the New Zealand dollar against the Japanese yen, and this is another possible basing type of pattern. Now again, firstly looking at this chart, you've got what reversal traders most like to see, and that is a really powerful move into what might be this basing pattern. And because the best of the reversal trades are often where you are effectively standing in front of the in this case under the falling knife or in front of the freight train, but you've got a bit going for you. You're not just entering when things are plummeting, but when you get this sign of loss of momentum and some sort of indication in the form of perhaps an oscillator divergence or some sort of reversing pattern, you're getting a clue that you might be going to start to reverse. And the classic entry to all these reversal patterns is when you break up out of the pattern. Now this one is a potential example of what you might call a 3 drives to a low type pattern. It probably doesn't really conform with the really purest Elliott version of events, in the sense that possibly this downward sloping resistance line is maybe not quite as steep as you might see in some of the texts. But what you do have here, I think the key to this is that you've got a potential flattening out of the rate of change. So you've got this fairly near vertical drop into that, and then the 3 drives down at a flatter rate. You wouldn't want it much steeper than this, but at a flatter rate at which you can draw a trend line across the 3 drives. And sometimes you'll get this last one just making a little bit of a false break down through it. And if you can get some sort of a candlestick clue to give you an idea that that false break may actually be a bottom, and not, even though it doesn't exactly respect the trend line, then that might allow you to confirm that it is a pattern. Anyway, a bit to go yet, but what you'll be ideally looking for is for a low to be made at about the level of this trend line. And again, we've got a possible sort of harami pattern going on here as I'm recording this, but we'll see what happens. And then a classic way of entering this is to look for an early entry once price starts to move back up and overlap back through the previous 2 lows. To look for a little bit of resistance line above that, which I've got with the mauve dashed line here, and a break up above that would then be an entry into this, the overlap giving you a clue that this whole thing is weak and corrective, and that the impulsive nature of the downtrend has ended, and then what you're looking for is a correction of this last major swing down. And if you can enter with on a break above the dashed line with a stop under the last low, if that last low is made, then that gives you a good risk reward entry, potentially with a relatively small loss compared to the sort of gain that you might have if we make a significant correction of this last move down. Well, that was my last chart for this week, ladies and gentlemen. Thank you very much indeed for listening in. Just some readers, listeners may not be aware that we offer a blog at CMC Markets. You can access that free of charge at blog.cmcmarkets.com.au. And what we do there is to look at the sort of things that I have now and discuss chart setups. And as I say, if any of these trigger in, I will come back and discuss them in a written blog over the course of the next few days. But we also provide commentary and general thought pieces on what's going on in the market. So if you think that might be of interest to you, it's free of charge, and you can easily subscribe to it just by signing up to the email subscription on the right hand side of the blog here, and that means you'll get an email every time we post a new blog.